Hey, good morning, everybody. It's Wednesday, July 1st, 2026. Welcome to the first day for the second half of 2026. Everything that's happened so far this year, we can put behind us. We've got a whole brand new start. We are ready for the third quarter, the second half. That's right, baby. We're a second half team. Let's make it count. Anyway, if you're here this morning, say good morning. Remember, I am Hammer, founder of Hammer Solutions, home of great products such as Originator, Success, Grab and Go Social, and Rate Sensei. You can join me live each and every weekday morning on Facebook and YouTube, 9:30 a.m. Eastern Time. Hope you are here this morning. If you're here this morning, say good morning. If you're watching the replay, do me a favor, give me a hashtag replay in the comments. Let me know that you were here. Let Facebook and YouTube know that you were here as well. Did my text alert go out? Because things are awfully quiet. I might send it again. Let's see. I have not seen it hit yet. Did I actually send it, or did I accidentally? Oh, there we go. Initiate processing. That's why. All right. I didn't hit that final button. It's fine. This is what a difference that text makes. Look at that. There's 9 of you on. So good morning, Deb Dickinson. Great to have you here as well. I'm going to stall for a minute, y'all, just while I give everybody a chance to get the text alert and hop in. Ron Siegel, good morning. Yeah, you just got it. Cool. Carly McLeod, good morning. Kathy Jensen, Eric McDonald. Great to have all of you here. I have not gotten it yet, as funny as that is. How crazy is that? So anyway, if you're here this morning, say good morning. Otherwise, it's let's throw the rate lock advice up there. So today, the lock advice is to lock anything closing in July. However, yesterday was a bad day. We did see a lot of reprices worse. We're going to talk about that. Still in a locking stance, though, because tomorrow we've got BLS jobs data, and I think things could get worse before they get better. So we're going to take a look at that and see where that leads us as well while everyone is coming in. So in the meantime, if y'all didn't know what I am watching, and many people would probably say it's boring as all get out. I understand. But I am watching the Sintra forum going on, and I'm watching it on the European Central Bank's YouTube channel. I guess it doesn't really matter where you watch it, but this is the ECB forum on central banking. The Sintra forum is an annual event organized by the European Central Bank and held in Sintra, Portugal. And this has, let's see if I can back it up so we can get, this is the moderator. I don't know her name off the top of my head. We've got Kevin Warsh, who is the new Fed chair. And I have to say, I'm actually very open to seeing what he brings to the table and a different point of view on things. Again, I could see myself being a Kevin Warsh fanboy. This is the governor of the Bank of England. I forget his name off the top of my head. Let's see if we can. This is the TIF, the Bank of Canada. I got to tell you, he's kind of a dick. At least the answers I've seen him give so far. Seems very bitter. Definitely very frustrated with America, but I guess who could blame them, right? So we've got the governor of the Bank of England, and then you've got Lagarde, who is the head of the European Central Bank and tremendously competent, intelligent economist. And really just it's very entertaining to me to see the interaction that they have and how much they actually agree on quite a few different things right now, and where that is bringing them, where that leads them, and kind of what that might mean for the future. I won't watch the whole thing by any means, but I was watching it this morning just to see where they were coming in from. So it was interesting. Sometimes this stuff, it can be pretty boring, but sometimes it's pretty cool to see what they have to say as well. So Ron Siegel says today is National Postal Worker Day. Please celebrate before they go postal. I know that's in bad taste. But yes, listen, the post office is highly mismanaged, way overpriced, and sometimes can be extremely frustrating for me. But at the same point, I do appreciate all my postal workers. So hats off. If you do know a national postal worker, give him a thank you today, because It's not always an easy job, and they probably get a lot of flack. So whether they're mail carriers or in the post offices themselves or the moving the planes and the trucks, again, it's not a perfect system, and it seems like it should be a lot better some days. But at the same point, I this is not terrible. So all right. Anyway, I'm gonna go ahead and let's jump into the rest of it and get to the good stuff here. Let's get to the good part. Let me flop back up here. All right, so let's go over the technicals, talk about where things are at this morning, where we're at right now. If you take a look, mortgage-backed securities currently down about 6 basis points on the day, 100.17, but that is a huge drop from yesterday. We're going to talk about that in a minute. 10-year Treasury yield back up to 4.48. You remember that it was all the way down to 4.37, so that may catch your attention as being a big jump, and that is also true as well. So let's do a quick recap and talk about what happened yesterday. Let me bump this up a little bit so that you can see. Okay, so taking a look here, everything in front of this dotted line, everything to the left side of it is what happened yesterday. Alon Sophia is getting in my shit. Say hi to everybody and stop being a pain. If you want to sit in my lap, sit on my lap, but I got work to do. So anyway, as we take a look at what's going on, you can see that yesterday, right about 3 p.m. Eastern time, it's right here. Everything was calm through the day. I mean, there was really not much of a move at all. Things were nice and easy and calm. And then at 3 p.m., we just got a huge sell-off. Everything just, it started selling and it just got worse. It was snowball selling after that. Yesterday, when you look at that candlestick, it's right here, this bright red candlestick, huge drop. We went from 100.60 on Monday to ending the day at 100.22. So we were down almost 40 basis points, 38 basis points in the 5.5 coupon yesterday. And again, we had talked about, I had been in a locking stance ahead of this because I had shown you here that bonds were showing signs of capping out. We were not seeing more improvement. The 100-day moving average, we talked about the last time that bonds were above the 100-day moving average was all the way here back in March at the end of February, before the whole Iran conflict. And bonds not ready to make a break back above that 100-day moving average. That's very, very telling. So big drop yesterday. We got no support from this red line. That was the 50-day moving average. Would have been nice if that had given us some technical support. The 25-day moving average, the blue line, no support there either. We just see things continuing to drop all the way down. We could argue, even before that, Ron had asked me about par. We said around 100. So I think we are near. We're at 100.19 right now. I think we're near. Let me refresh this so that candlestick will change a little bit, because it's improving. So this is a green candlestick. So it's actually up to the top. Even though we're down on the day, we started much lower. Let me make this 3 months so you can see the candlestick's a little bigger. So see this candlestick for today? It's green because even though we are down, we're in the red. We're down 4 basis points on the day. It started the day because of overnight trading much lower, and it's worked up on the day. That's why it's green on this chart. You can see here we started lower in overnight trading. And we've bounced up since then, right? So we are getting some. I do think we're going to see a little bit of a bounce. Now, what makes this so difficult, and the reason I would normally say, hey, let's float. Let's cautiously float on this. Let's see where today goes. Let's give it a chance for some recovery. This was an overreaction. The problem is we get the BLS jobs report tomorrow, Thursday, instead of Friday. Markets are closed on Friday for the holiday. They're closing early on Thursday at 2 p.m. Eastern time. So we're going to get this BLS jobs report tomorrow, and we are very likely to see a reaction to the data, and I don't trust the reaction. Last month, I figured that we would see a very calm reaction to the labor market data. Markets were pretty set on what they thought the Fed was going to do. If you remember, we had the Fed meeting had been on June 17th, that Wednesday right here. This is a huge red candlestick, right? And the labor market data before that had come in before we had that change up last month. And we saw a huge negative reaction. Now, we could see a lot less of a reaction to tomorrow's BLS jobs data because markets are already pricing in the idea that we could see a Fed rate hike as soon as the next meeting. But that's kind of where we'll have to see. So anyway, today rate sheets are going to be worse. If you had to take a look at it, when you take a look at where we're at, 100.19. Last time we were at 100.19 was Thursday, June 18th, right? So if we look at Thursday, June 18th, you could see that things were around 6.58. Just to get a rough idea where lenders were pricing, it was below 6.6 this morning, probably going to be somewhere right around that same. I don't believe that it would have closed yesterday at 6.54. There were most lenders repriced worse yesterday, and I think reprices worse were worse than this. Again, I don't. It's not that I think Matt Graham is wrong, but this just doesn't pass the sniff test for me. I think we're back up to 6.58 ish. Is what you're going to see. It's not terrible. I mean, we're still within an eighth of a point. We are really seeing rates stay more stable than you would expect. Reprice risk on the day is low. I don't think we have to worry about more selling today, but you do see that volatility. We were just up a couple basis points. Now we're down 9 basis points, but I don't think we're going to see another big sell-off. I don't think we have to worry too much about that. However, we get the BLS jobs report before tomorrow's jobs data. So tomorrow's rate sheets are going to be there, and they're going to be conservative because it's going to be a long holiday weekend. So everything that's kind of happening tomorrow and all that uncertainty, no crystal ball. It just, even though we've lost some ground, you gotta consider locking. Let's see what you guys had to say. Ron Siegel said Matt Graham shared some great insight in his market wrap on what happened yesterday with the triple witching. I didn't see his market wrap on the commentary. I don't know where he posted that because I don't see that. I don't see the yesterday's. I see, or was it here the reprice? No, see, I don't see that. Maybe it was somewhere that I don't see it. Otherwise, I'll take a look at it. You tell your buyers you can't lock until they sign their initial disclosures. I had disclosures go out Monday afternoon, told them to sign before 8 p.m. They listened, and I locked Monday night. That's good, James. That's good. I've been in a locking stance the last couple of days because you want to protect against this. It's not that I knew that this was going to happen, but we had talked about the fact that in the technicals, bonds were capping out here. The 10-year Treasury yield, being below the 50-day moving average. It was below the 50-day moving average for a few days. Remember, going all the way back here 6 months, the 10-year hasn't been below the 50-day moving average since back in before the Iran situation also. And then you can see now it's back above it. Yesterday, it closed above the 50-day moving average. It closed at 4.46, and the 50-day moving average was 4.45. This morning, back up 4.47. So it is pushed back above it when we look at the technicals, and that's kind of what we were putting in. He shared it at 12:59 p.m. PT in the news stream. Okay, I'll take a look. I don't know what the news stream is. Let me see it. News stream. I don't know. I'll take a look and see. Maybe articles. Is that what the news stream is? Articles somewhere. I don't know. I don't. You can tell. I do respect Matt Graham tremendously in his acumen. So, but I missed that. I didn't see that. So, anyway, let me take a look and see what else we need to hit on going into this. So, the reprices today, like I said, it's low. However, tomorrow we've got the jobs data, and there's just too much chance for uncertainty. If we see, it's not just what the data itself comes in, it's how will markets react. Right now, markets are pricing in the idea of a possible Fed rate hike at the July meeting in 4 weeks at 66% chance staying the same, 33% chance or 34% chance of a Fed rate hike. When we get into the September meeting, the chances of a hike up just about 67% here. Expectation of a hike by the time we get into the October meeting, that goes up to 73%. By the time we get into a December meeting, by the end of the year, it is now at 80, basically 83%, right? So the question is, if that labor market data does come in showing strength like the JOLTS data did, we've seen, are we going to see these numbers jump? Is that going to increase the chance? Now, Kevin Warsh at his last press conference during the Fed meeting, he really emphasized the view of inflation, and he really didn't talk about the labor market. So a strong labor market could make it more likely in traders' minds that the Fed is going to hike rates. And that's what I'm afraid of. Even though Kevin Warsh is starting to try to change the paradigm of how things are being viewed and reacted to at the Fed, which I think is actually really healthy. I mean, it's an antiquated way that they look at, rear-facing data. I would love to see them. I mean, he's talking about doing the new subcommittees, and we'll see where this goes, right? And he's talking about that on that video that I showed you guys when we were getting on. But the question is, if we get a strong reaction, what will happen? Now, you will see some money parked in bonds tomorrow for the long weekend. That does happen. But you're going to see very conservative pricing from lenders as well, because they don't want to get caught with any problems for overnight. So Ron Siegel, I'm floating on the 7-day, too big a move yesterday. You think we'll get a bounce from the big move? I would cautiously float to start the day, but I would look to lock by the end of the day, especially if we do see things go negative. Ron's talking about floating. I don't know, Ron, without seeing a positive reaction this morning, without us being up at least 3, 4, 5 basis points this morning, I don't think that markets believe yesterday was an overreaction. And being that we're down already on the morning, I'm into the locking stance. So, but I appreciate you sharing what you're doing. ADP had a miss today. I'll look at that one. I didn't look too closely. I'm not too worried about that anyway. It's not going to equate anything to what we see on the BLS report. So, all right, my friends. Well, anyway, so I think I hit everything. Let me just look at some of the other articles here, see if there's anything. Traders boost Fed funds shorts in risky July rate hike wager. Traders in the Fed funds market, which is remember, the Fed funds market, that's what CME has here with the Fed Watch tool, right? That's what they're doing. Traders in the Fed funds market are increasing bets that the Federal Reserve will start raising interest rates as soon as July, with interest rate swaps pricing in about 9 basis points of a quarter point hike. I love how they do it in some weird, they don't do it, like what are the chances of a hike? Not what this. Open interest in the August Fed funds futures risen from around blah, blah, blah. Flattening yield curve reflects market's balance of risks shifted from the labor market to inflation, with the spread between the 2 and 10 years shrinking by about 15 basis points. Remember, part of the reason that you're seeing a shrinking in the yield curve is because traders don't believe that we have to worry about inflation a year from now versus the inflation we're dealing with right now. So that's why you'll see that change and shift like that. But all right. Well, anyway, I think that's it. 18 minutes in. It's certainly been, I've certainly done enough. So let me remind you, if you would like to join me live as I go live each day, make sure you sign up to get a text reminder. We send out a text as I'm going live with the links to join on Facebook and YouTube. You can sign up at hmmr.io/reminder or use this cool QR code over here. If you're on your phone right now, take a screenshot. Go to your photos. I know on Apple, if you press and hold the QR code in your photos, it'll still bring up the link. Also, remember, you want to consider signing up for our daily email lock advice that goes out each morning, www.ratelockadvice.com. So you have it at your fingertips. It's a quick read. It's absolutely free. Make sure you share that with other loan officers as well. I always appreciate that. We have a paid text alert service. You don't have to spend $50, $75, $100 plus a month to monitor the candlesticks, right? We will keep you posted. Yesterday, we sent out an alert before there was a single reprice worse. Let me go ahead and let me pull this up and bring this over here. And I'm going to share the window here. All right. So yesterday, we had this alert. Oh, that didn't work. Never mind. Let me do this. Let me turn off this. There it is. So we had the alert yesterday, right here at 3:39 p.m. when reprice risk started to. Oh, that doesn't work. You can't see my. Okay, that's good to know. So anyway, right here, as bonds hit their worst levels of the day, we sent out the alert and saved most people before the reprices came in. And in fact, when did reprices start to get reported? 347. And that's UWM, which we know reprices. Oh, you guys can't see it. Hold on a minute. Let me just share my screen, because I'm sharing what I was sharing was a window and it wasn't doing that. There you go. Okay. So this is Mortgage MBS Live. Users report reprices, and the first reported reprice 347 at UWM, and at 339 is when I had sent out the alert. So you can go ahead and sign up for our text alerts, and they're $7 a month. So check them out. All right, everybody, I'm going to go ahead and wrap it up. Thanks again for joining me. I'll see you guys tomorrow. Tomorrow will be, of course, we'll go over the BLS jobs report. We'll talk about what's going on, and that'll be the wrap up for the week, because we won't have a live on Friday because markets will be closed on Friday. So, all right, I'll catch you guys